We have Vetri Subramaniam, Chief Investment Officer at UTI Asset Management Company, who's with us. Vetri, good to have you with us here. Thank you for your time. What's the view at UTI, Vetri? Market view. Is the fall done, or is there more to go for large caps and mid caps and small caps as well? What's the sense?
Sure. Good to be here, Prashant, and talk to you. Yeah, very quickly, I think, we've been concerned about market valuations for a fairly long period of time. The sell-off, which is sort of, accentuated right from September, I would say, breaking it up into the components that you said, as far as the large caps are concerned, we would, the way we look at our consolidated equity valuations, I think it's back within the fair value territory. It's still not cheap, but it's within fair value. And fair value is a reasonable good territory for investors to be willing to, enter the waters and start allocating money to large caps. So from our point of view, large caps, there is comfort. Where we still find the valuations in aggregate expensive is really in the mid and small caps. Particularly, I would highlight mid-cap valuations. These are at a record premium to their own history and at a record premium to the Nifty. So we would be slightly uncomfortable in that space. Same holds for the small caps as well, though the small caps have seen a little bit more of a sell-off. But in aggregate, still not something that we are particularly excited about. But I should admit, when I look at the Nifty 500, you've got about 25% of the stocks which are down more than 40%. You've got close to 70% of the stocks which are down more than 25%. So there are more opportunities that you can hunt around for at a stock level. But when you talk about the asset class valuations of 250 small caps or 150 mid caps, I still find those very rich.
Mid and small cap valuations still rich. Vetri, good morning. Just give me a moment, just going back to L&T Tech, because I was pointing out to viewers that this sudden big surge on the stock. And now Nimesh has alerted us why it's because of brokerage notes. L&T is right now up 4%. There's a Macquarie note, and we'll put it out in just a bit. Macquarie is a 5,100 rupee stock. Macquarie thinks it can go to 6,500 plus. They're quite bullish on L&T Tech. The other one is Bandhan Bank. Bandhan is reacting to a CLSA note. Again, an outperform rating coming in from CLSA, and CLSA thinks Bandhan from 141 can go to 220. So just pointing out on the back of brokerage moves. More coming up on why these brokers are positive on these stocks in just a bit. Vetri, hi, great to have you on. So, you've started off by putting that caution on the table with respect to valuations. Now, the question is, what does one do in this market? And I think people are still wondering if what you're saying is that mid caps are probably still a little overvalued. So do you start deploying some money in large caps, or do you just sit tight, ride this out, and just prepare for a year of low returns? I mean, could it be that kind of a year, 2025? What do you see ahead?
Well, point number one, the market really doesn't care whether it's your birthday, your anniversary, or financial year or calendar year returns. When you look at 10-year returns and you look at rolling returns over 5-year and 7-year periods, what you will find is that they are never evenly distributed. So my first recommendation would be stop thinking about it on an annual basis. You've got to think about it in terms of, I would say, somewhere between 5 to 10-year rolling periods. And, that's what really influences your outcome. So don't invest today because you hope to beat the FD return. A year ago, people were very confident that they could make 20% a year. Who needs fixed income? Now they're suddenly worried about the fact that they're not making as much as their fixed deposit or as much as a fixed income fund. But that would lead me to what I would say, to my mind, still remains a very good opportunity for investors, which is to consider the hybrid set of funds. The reason I say that is that it's got a balance between equity and fixed income. Of course, those percentages could move around based on which mutual fund category you look at. But the reason it's attractive is that your fixed income part of the portfolio is giving you a reasonable positive carry and spread over inflation. And at the same time, you're not 100% exposed to equity. The aggressive hybrids typically run at 65-70% equity. And of course, you could also look at, the strategies like the balanced advantage or the multi-asset allocation strategies, which, could dynamically readjust their equity exposures. So to our mind, hybrids are really, should be the choice of investors looking to deploy in lump sums. If you do want to go for pure equity, then we would recommend large caps, but we would still recommend staggering those investments over time.
So don't be greedy. I think that's in a sense that's the advice, right? Overall, stop being so greedy. But Vetri, let me ask you something that another market commentator brought up, and I think it was a very, very relevant point. We're now paying capital gains tax at 12.5%. So when you speak about look at long-term rolling returns, equity returns still need to be substantial enough to be meaningful net of tax. So then, what is this, average 10-year rolling return if I sit in my fund or if I sit on my stocks and forget about it for the next 5-7 years? What is that realistic expectation that that investors can still have where equity still makes sense net of tax?
Sure. Well, remember, you are in an economy which is growing in nominal terms at about 10%. So, that's sort of the aggregate outcome for incomes in the country. You are in an economy where the central bank is targeting a 4% inflation rate, let's say 4 plus or minus 2. So you've got a 10-year bond yield at about 6.8%. You add some equity premium to that of maybe 5 to 6%, you'll get to 11 to 12% number. So whether I come at this from what is income growth, or I come at this from a classical construct of bond yields plus risk premium, you will end up with a equity return at an asset class level, which is somewhere in the region of, let's say, approximately 12%, which actually corresponds very well to what we've seen in terms of the average rolling returns over a 10-year period. So that's the number to work with. Now, if you are saying 12% is not exciting enough for me, I think you've got to rethink, because look around you and see how many businesses are capable of generating, more than 15% return on capital consistently over long periods of time. And the answer is that's a handful. So I think people need to be practical and realistic about equity expectations. The asset class can deliver you 12%. If you want to improve on the 12%, you've either got to be a great stock picker, or you've got to be able to use asset allocation to be able to maneuver to the asset class when it is more attractive, which also means you'll have to invest in that asset class when the news is extremely challenging and things are looking extremely pessimistic, and you'll have to take money off the table when things are very, very rich and markets are expensive. So you will have to use one of these two strategies, either stock picking or asset allocation, to improve your returns about 12%. And of course, those of us who are in the active management business would say, if you choose the right fund, you could also get an alpha out of it. But 12% is the benchmark. So I'm sorry if I'm, disappointing somebody, but I think when we talk about investing to achieve our financial goals, right, and that's the starting point of all investing, you should not be modeling for equity returns of higher than 12% unless you can bring one of those three strategies that I talked about: stock picking, fund picking, which is alpha, or asset allocation.
Go back to rules of investing 101. That's what Vetri is saying.
Well, Vetri, I'm very, very realistic. I'm a loyalist with regard to my SIPs for my children, and 12% I'll be very, very happy on an average over the last, the next many, many years. A 15-year time frame is what I have, and 12% compounded growth is good enough for me, so that's the way I would look at it. But let's talk about stocks and sectors then, which is the theme that is standing out right now. These pullbacks in the market actually are sometimes, make select sectors look very, very good. So if you say, a sector that you'll be, most optimistic on, give and take everything, hearing about tariffs, the economy that slowed down a little bit, the hope of the recovery later this year, what would that be?
Well, Nigel, I did a long conversation with Surabhi many months ago, and I said, the one sector that I find, despite all its challenges, looks reasonably well placed is banking and financial services. Nothing much has changed in my view. That still remains the one sector where I think, the starting point in terms of valuations, Nigel, is attractive. And to my mind, when you take care of investing by minimizing your risk, by getting in at sensible valuations, the future takes care of itself, as long as you're invested in sound, solid businesses. So I would still point to banking and financial services as the sector where I have the maximum amount of comfort. Into the sell-off, we are seeing some assorted pockets, in autos and in maybe things like power, which are starting to look more reasonable. But if you ask me to, name a sector, this is the only one where I'm still very, very comfortable. Outside of that, it's more about stock selection.
But on financials, Prashant, if I could just kind of press that point. I remember that was a Market Cafe conversation, and we spent a good half an hour, more than half an hour, understanding why you're so optimistic on BFSI. But Vetri, since then, I'm just throwing the narratives at you, right? People are now saying that you have to go slow on your high-yielding segments like unsecured. So, will you really make enough margin? People are saying that, maybe the growth itself is not going to come back. Plus, there is the fact that FPIs are disenchanted with the Indian market. So, therefore, bank stocks are not working. How do you sort of deal with some of these issues that have cropped up since then?
Sure. Surabhi, so I would, completely agree with you on that. I think what's been disappointing over the last 6-7 months has been the fact that because the monetary policy restraints have been, not even monetary policy, it's actually RBI's restraints on the banking system have been so tight. You've got this tight liquidity situation. You've effectively sort of talked the banks into saying, slow down your credit growth, correct the credit deposit. Whereas the reality is it's the RBI which has got to ease up the liquidity. Now, for whatever set of reasons, they were not doing that. But I'm glad to see that in the last few weeks, they've certainly started to open up the tap in terms of liquidity. And I think once you start to see RBI's contribution to creation of money supply go up, some of these liquidity issues will take care of itself. I think RBI's intervention 2 years ago in terms of slowing down some of those unsecured credit avenues, certainly in retrospect was a timely intervention. But I think they also realize that at some point of time, if you don't allow credit to flow into the economy and grow ahead of nominal GDP growth, it will constrain our long-term growth prospects. So I think, I'm of the belief that sooner or later people will, come to their comfort level and say, okay, this is a time where we've got solid set of banking and financial services institutions with strong balance sheets. Let the credit growth, continue. And I think that could easily grow well ahead of nominal GDP growth. And that's a very favorable environment for the financials.
All right, Vetri, we leave it there. Thank you very much for joining us. Good speaking with you, and it's a pleasure hosting you here on CNBC TV18. Well,